Okay, folks, welcome to the Best Stocks Picks video. This week we're going to go over IWM, which is the Russell 2000 ETF, PBY, which is Pep Boys, LMOS, which is Lumos Networks, GIMO, which is Gigamon Inc, RSH, Radio Shack, TZOO, TZOO, CNSI, which is Comverse Inc, IMPV, which is Imperva Inc, MFRI Inc, and DSCI, Derma Sciences Inc. Last one will be Tier Lab Corp, symbol TEAR. That's the order we will be going in. But before I get into going over the analysis of the charts, if you're watching this video on YouTube, please subscribe to my channel. If you're watching this on the website, please enter your email address. That way you're notified when I send out these videos in the future. And we hate spam too. I guarantee you will not be spammed. So let's get to the charts. IWM, Russell 2000. This is a daily chart. I'm going to be using all daily charts. I use multi-period chartings with members on the week ahead commentary, which goes out on Sundays. Every Sunday, it goes out to members, and I will be going over the market pulse check. That video is a review of the health of the overall stock market. And then the second video is the focus stock video, which is where we'll go over all of these symbols in detail, meaning multi-period charting, weekly, monthly, intraday charts when necessary. And we'll also go over our current holdings and the strategy that we have for either booking profits or, if necessary, lifting our stop loss orders to keep our losses small. So let's take a look at where we stand with the Russell 2000 on a daily chart. We are, on a daily basis anyway, we are in a confirmed downtrend. When earnings season hit, the IWM was in oversold territory. You can see we had some bottoming tails here. We were below the lower band of the declining downtrend channel. Earnings season hit, and of course the propaganda on CNBC began. All the companies were beating by a penny on reduced forward-looking guidance. Big deal. Take a look at their sales. Sales are not that great. So we have been rallying on the propaganda, and there's no surprise there. I would expect that after earnings season is over, that we'll probably see some further weakness to the downside. In fact, you saw some topping action on Thursday. Friday, it was Good Friday, and the markets were closed. You had resistance at 113. It'll be interesting to see whether or not we can continue higher, or will we get stopped here and then roll over. The jury is out. We'll get into further detail on the week ahead commentary with members. All right, so we're in a confirmed downtrend on a daily basis. Why is that important? Well, up until a few weeks ago, we were making our bread and butter trades on continuation breakouts, on stocks that had high beta, high volatility. That trade is over because what we saw was stocks that were on a watch list like PBY, which were in pennant formations, begin their breakouts only to fail and break back down into those prior pennant formations and not only retest the lows, but break down below the lows. And in the case of Pep Boys, which we never did get involved with, thank goodness, it broke down through critical support at $11.21. So this is a stock that looks like it wants to head lower. I would not be a buyer of PBY. I would expect that it would be hitting our extreme oversold watch list in the near future. So how are we trading the market right now? We're trading stocks like Lumos. This stock was an extreme oversold stock, and we began buying it up. The first day was on 411, and then we doubled our position on 414 as we saw these bottoming tails form. What does that mean? It means that you have support below. There are buyers below. And we also took a look at the weekly charts. I'm going to prepare a video on the Lumos trade to illustrate how we're trading the markets right now. We changed our strategy, and we used multi-period charting. We used weekly, daily, and intraday charts, primarily the 30-minute chart, to identify the best risk-to-reward entry point. So we entered on the 11th and then doubled our position on the 14th. The stock rallied, and we booked profits into the $12.50 level. We booked profits of 8% with only a few days of being involved with the stock to the long side. Now, could we have made a few more dollars? Absolutely. Now, could we have stuck around and tried to eke out a few more dollars worth of gains on Thursday? Sure, we could have. But let's face it, folks, this is a stock that is in a bearish downtrend, and normally when you have a counter trend move on a stock that is in a bearish downtrend, you will see the stock begin to roll back over again and make lower lows. Now, am I going to allow an 8% profit within a couple of days slip out of my hands, $3,600 profit? I don't think so. So we booked profits. We were happy with our gains as we hit resistance, and we booked profits. I sent out an alert to members, and we were out. Now, I would expect the stock to probably begin to weaken, note the topping tail into resistance, and probably pull back. Would I be interested in LMOS once again? Yes, but as a longer-term investment, because the stock has been in a long-term downtrend, if we put in a double bottom retest at $11.20, we may look to open up a new position in LMOS to the long side, or if we pull back, put in a higher low, which implies that you have demand for the stock, then sure, we would look to get involved with the stock, and we would buy more on a breakout above resistance. As of right now, though, it's a watch stock. We've booked our profits. We moved to the sidelines. Now it's off to greener pastures until LMOS shows us that it has the ability to pull back, put in higher lows, and is able to break out above resistance. That is an indication of demand for the stock. Now, GIMO is another stock. This is one that we've added to our watch. It's an extreme oversold stock, as all these stocks are that I'm going to go over. No longer are we looking at stocks that are breaking out, and will we trade them as momentum trades? That trade is over for now. Now we're looking at stocks that have extreme oversold conditions because we want to manage our risk to reward. We believe the stock market is weak. It will probably resume its downtrend in the coming weeks after earnings are released. So what do we want to do? We want to buy stocks with limited downside risk. GIMO is one of them. We have an RSI of 19.29. It's already rallied a little bit off the lows of 14.75. What we want to do is we want to pull back using multi-period charting, take a look at the weekly, monthly charts, see whether or not we have historic support where GIMO will pull back, and we can look for a great risk-to-reward entry point. Now, right now, would I touch GIMO? No way. My guess is that from these topping tails here, you're seeing resistance at $16 per share. Any move higher above $16 per share will probably be met with sellers. So the risk to reward is not in our favor. Now, if the stock pulls back to 14.75, perhaps we're interested. But what I'm really interested in, and this is what I'm going to be going over with members on the week ahead commentary on Sunday, is what do the weekly and monthly charts look like? Do we have a better risk to reward entry point to get involved with the stock? That's the question that needs to be answered. So you could see how GIMO fell victim. It broke out in early March above the upper band of the declining downtrend channel. It looked really good, and then it failed, rolled back over. The lower band of the pennant formation was not strong enough, and the stock market is a beautiful thing. Don't go listening to the people on CNBC now all of a sudden that they're talking about high-frequency traders, how bad it is. Sure, it's bad. I've been saying it's bad for months now. But that doesn't impact us as swing traders. Marginally, very, very marginally, does it impact us. How it can impact you is if you're a day trader, an intraday day trader. Otherwise, it really has no measurable impact on you, unless, of course, these block box algorithms that they have out there, all those ghost bids they have out there, all of a sudden disappear and the stock market just falls apart like you had with the flash crash a couple of years ago. So GIMO, I digress. I apologize. I'm passionate about that topic. I can't stand high-frequency trading. They think that they're doing us a favor by skimming the market. Anyway, again, I can go over it all day long. It broke down, GIMO did, below the lower support. The stock market's a beautiful thing. It rallied. It showed that it had resistance, rolled back over. If you did not get out on this breakout, it gave you a second opportunity to get out. And sure enough, after that failure, it broke down. And here we are today. down at 14.75 when the market sent you a signal at 31.78 to get out. Charts are a beautiful thing. You can look at the fundamental analysis, the annual reports, the quarterly reports, all that you want. It will not tell you as much as charting will, because charting is real time. We are not in the boardroom. We depend upon the charts to tell us what's going on with a stock. So GIMO is a potential long. And I will go into further detail analysis with members on the week ahead commentary. Next stock up, Radio Shack, RSH, the symbol. Okay, this is a stock that's got serious problems. It's restructuring. They want to close, I believe it's a quarter of their stores. The banks are giving them a hard time. So there is a question of what I believe could be ongoing concern issues with RSH. So it's questionable as to whether or not we'll be involved with this. I need to do a little bit more research. So let's make the assumption as I'm doing this analysis that there are no ongoing concern issues. We have a stock that is broken down below critical support at $2 per share. It's sick, and the probability of it continuing to get sicker is very, very high. We have an RSI of 15.68. Those of you that read Technical Analysis for Dummies and they tell you that an RSI below 20, that's when you're supposed to buy the stock. That's a joke. If you listen to that rule, you go broke. An RSI of 15.68 on a stock that's trading below $5 per share is nothing. It can go a lot lower on the RSI. So what we want to do is take a look at historic support and resistance levels. And if there are no historic support and resistance levels, what we want to do is we need to take a closer look at the daily and intraday chart to show us if there are divergences, if there is a sign that we have buyers below. Now, I could tell you from the volume that you have a lot of selling going on. There's institutional distribution. The markets gave you a clue back here, and back here, that this is a sick stock. You have institutions selling their shares, and that you need to avoid the stock. So we'll be looking at this very, very closely, daily and intraday, because I'll let the cat out of the bag. There is no historical support on this stock. So please be careful. Do not go jumping into RSH on Monday morning, because you will probably get burned. TZOO, Travel Zoo, high beta stock, broke down below critical support. This is another stock where the market sent you a signal. You had a big short squeeze, and then you had a big reversal off of 26.98, which was prior resistance. If you had the opportunity to recover some of your losses and didn't pay attention to this reversal day, well, then you weren't paying attention to the charts, because the market's a beautiful thing. It sends you signals, and it told you here to get out. And you had your pullback, putting in lower highs. We pulled back to critical support at $20 per share, seen back in October, November, January. And when we closed below that level in April, you had to get out, because the markets were telling you the support that was back here in these months is no longer there. You have more sellers than buyers, and you had to get out of the way. Now we have an RSI of 16.13. Very, very interesting. We'll be taking a look at the historical charts. This is one I have not looked at yet, unlike RSH. And we'll look for a great risk to reward entry point. I can tell you from looking at this candlestick, we're probably heading lower. This is a very, very bearish candlestick. I would avoid this stock at all costs. Take a look at your volume bars. Clear indication of institutional distribution. You have to avoid it right now. The risk to reward will come into your favor, but it's not there just yet. Next stock up, Comverse Inc, CNSI. Was in an uptrend, and the market sent you a signal with using the RSI. In fact, it also sent you a signal using the ultimate oscillator, because as we rallied to all-time highs, and we came off of an overbought RSI and an overbought ultimate oscillator, and we resumed our uptrend and broke out to new highs, the RSI and the ultimate oscillator were failing to confirm the move higher. In fact, they were weakening. Then you had your bearish key reversal back in January, and that was your sign to get out. And if you didn't get out on this bearish key reversal, your second opportunity to get out was a close below 37.88, which marked critical support. and a broken uptrend line, well, then you missed your opportunity and you're in a world of pain. And here we are at the lower band of its rising uptrend channel, broke down below that level. Now you're looking at a 50-day moving average, which is threatening to take out the 200-day moving average. RSI is currently at 18.75. Huge institutional distribution. You have to sit on the sidelines, take a look at your historical support levels, and see where your best risk to reward entry point is. Is there risk to extreme oversold stocks? Absolutely. And there are a few risks. One is that you get involved with the stock to the long side because you're reading books like Technical Analysis for Dummies, and it causes you to buy because the RSI was below 20. It's a joke, folks. You don't want to play that game. Or you see that the chart looks so ugly, it can't get any worse. Absolutely, it can. Extremely weak stocks have a tendency to get weaker. What we want to do is we want to accumulate a position as we near historic support levels. And we want to identify those stocks that have big short interest. And those shorts have fallen asleep at the wheel. They've gotten comfortable with their short, and they feel really comfortable with the stock is going to continue lower. All of a sudden, it stops going lower, and there is a small door for them to get out of. And that's called a short squeeze. And we want to take advantage of that short squeeze. So that is our catalyst to the upside. So after doing our proper due diligence, what we want to do is we want to watch and wait. We want to take a look at historical support. We want to see if there are bottoming tails forming, which is a sign of support. We want to watch the volume bars. Is the selling dropping off? How is the intraday price action? Are we selling off in the morning only to close higher in the dates in the afternoon? These are incredibly important observations, and the market is a great thing. It sends you signals. You just need to put the puzzle together and be able to act on those signals. Next stock up is IMPV, another stock that wasn't an uptrend. It pulled back. You had a topping tail here, a sign of resistance. Then you had a bearish retest of the lower band of the rising uptrend channel, which we broke down below. Then we rallied, and you could see that we put in a lower high. Never good. So when was it time to get out of this stock? It was time to get out of the stock when we closed below the lower band of the rising uptrend channel, but the markets gave you an opportunity to get some of your profits back or losses back by rallying, because markets never go straight down, and you're paying attention to the charts. Now, if you had the lower band of the rising uptrend channel drawn on your charts, you would have expected some resistance at that level. And when we pulled back on this day here, on March the 24th, you should have drawn a line in the sand. That was your low. And the rule should have been, if IMPV closes below this support level, you're going to get out. Keep your losses small, because the probability of us making lower highs and lower lows is very, very good. And sure enough, that's exactly what happened. Now we're talking about it as an extreme oversold stock. So we had a nice bottoming tail here on the 15th of April. It rallied, resistance at $28 per share. Now we're looking forward to resume its downtrend. Note, the 50-day moving average is threatening to take out the 200-day moving average. That is a major concern, especially if we get a continuation rally, because the stock will more than likely see sellers come in when this 50-day moving average crosses below the 200-day moving average. So it's a watch stock only. And as with all of these stocks, it's fairly simple. You just need to be disciplined in your approach. What do we want to do next? We want to take a look at our weekly, monthly charts. Where is historical support? Where is there a probability that there are buyers in there willing to step up and begin to accumulate shares? Is there a large short interest? And these are all the questions that we'll answer on the week ahead commentary with members on Sunday. Next stock up is MFRI. I have no idea what this company does. I have to be honest with you, and it doesn't matter to me. As long as there are no ongoing concern issues, all that matters to me is where the stock is trading, where has it traded on a historical basis, and whether or not there is an opportunity and a catalyst for us to make money to the long side. Now, here's a stock where the markets once again told us, it told you to get out on this double top here. It rallied up to 1678, pulled back. Would I expect it to sell it? Not necessarily. It was an okay uptrend. But when it put in this double top, this lower high with these topping tails, that was a sign that you had to get out because down volume was rising. And we pulled back, took out support at 1491, pulled back to the lower band of the rising uptrend channel. You had to get out because it rallied up, put in another lower high. The markets gave you another opportunity to get out. It even made a new high at 1744, key reversal. You had to get out, folks. This is a very, very bearish signal. And sure enough, we've broken down. This is another stock. We're waiting for the 50-day moving average to threaten to take out the 200-day moving average. And I can guarantee you there are lower lows to be defended on this stock on a historic basis. I would not be a buyer of the stock at this point in time. Take a look at your volume bars. Very, very strong down volume bars. Institutional distribution. You do not want to fight the big guys. And these are not people that are selling 100 and 200 shares. This is not mom and pop doing that. This is Fidelity. This is Goldman selling their shares. You don't want to fight those guys because they will roll you over. Next stock up is Derma Sciences, DSCI. This is one that I really like. RSI 14.96. Extremely oversold. I like this stock for a number of reasons, most of which I will go over with members on the week ahead commentary. But the one I'll go over on the daily chart is that we have an RSI of 14.96, extremely oversold. We have some bottoming tails forming. Does that mean that there's a bottom in the stock? No, it does not. Yeah, the 50-day moving average, which is threatening to take out the 200-day moving average. Normally that would be bearish, but I'll tell you why that would be bullish on the week ahead commentary. Members, stay tuned for that. We do still have some institutional distribution. How do we know that? It's when you have your volume bars to the downside, which are meeting or exceeding the average daily volume, is highlighted in red here in this line. Ultimate Oscillator looking pretty good. I happen to like it. Stokes looking pretty good. This is one of our top picks for the coming week. Derma Sciences. Stay tuned for us probably getting long of this one this coming week. Perhaps on a Monday, though, so don't go jumping in both feet. Members, I'll be sending out an alert, as I do with all our trades. Okay, next and last stock up is TEAR Lab Corp, TEAR, the symbol. This is another one, folks, where the market sent you signals. If you were long of the stock, that you needed to get out. The stock wasn't an uptrend in the summer of 2013. It flashed a reversal day. It pulled back to its 50-day moving average, rallied up to 1428. Another huge wick. When you see these wicks, it's a sign of sellers. And it couldn't break out to new highs. If you had profits, you needed to book those profits and move to the sidelines. And you could see that we entered a long-term downtrend line. We began a consolidation, a pennant formation. And every time we hit the upper band of the declining downtrend line, you saw a wick form. And that wick is a sign of sellers above. And you don't want to fight that. Because all too often, what happens with members that join the Contrarian Trader, I'll quiz them. They'll send me a stock to take a look at, and I'll say, well, what do you like about the stock? What's exciting you about the stock? Why do you want to buy the stock? And I do it for a reason. It's to draw them out, draw out the psychology, because the market's all about psychology. And there's an old saying, and I've lived by this saying. And the saying is this, and this is not to be derogatory towards anybody, because I apply it to myself. And the saying goes like this: fools fear when they should hope, and hope when they should fear. Now, the markets, every time you hit the upper band of the declining downtrend channel, the markets told you with these topping tails that there were sellers here, and that if you had hoped that the stock was, this time around, was going to break through and you were going to make big profits, you were going to get into the stock before it broke out, and you were going to make big, big profits. If you had that type of hope, it made you a fool because you were taking too much risk. The markets told you, avoid the stock when it hits this upper band. When do you want to buy it? You want to buy it on a breakout and it close above this resistance level. And when it pulls back to retest that resistance level, that's when you want to add to your position. Not before then. And if you were fearful of buying when it hit the lower band of the pennant formation, because the markets told you that at this point in time, this is a pivot point. It was resistance back here. It broke through that resistance level. It rallied, pulled back, held. And although it pulled back here, it didn't hold. You could have used a stop loss order just below that support level, and you could have gotten out, because the markets told you that this should hold at $6.80. If it does not, keep your losses small and get out. The markets are a beautiful thing, folks. And in this case here, you have an extreme oversold stock. I don't know what this company does. I can tell you one thing. It is in a parabolic move downward. You have institutional distribution. You do not want to fight these guys. You want to wait till these volume bars drop. You want to take a look at your multi-period charting, your weekly, your monthly charts, whichever one's going to show you where it's got historic support, and then look to begin accumulating shares. Assuming that the volume is dropping off to the downside, that you're seeing some bottoming tails, that your oscillators are beginning to firm up and telling you that, you know what, okay, it's okay to re-enter the water and begin to accumulate shares. Note how I keep saying accumulate and not jump in with both feet, because that's how you will get burned if you buy all at once. And I'll be going over all of these charts with members on the week ahead commentary on Sunday, using the multi-period charting theory that I always use. And when we want to get involved with these stocks, and not that I will be trading all of these stocks, there'll be 2 or 3 that I'll probably trade, but we'll choose the best of the breed. And I don't mean that on a fundamental basis. I mean it on a technical analysis basis. So, folks, again, if you're not currently a member, sign up for the 14-day free trial offer. If you're watching us on YouTube, click the subscribe button. If you're watching us on the website, please enter your email address. You'll get notified of whenever I send out the best stock picks video or our post-trade review analysis videos. And again, you will not be spammed. We hate spam too. I will talk to you soon, folks. Have a great remainder of your weekend. Have a profitable week.